Hi everyone, hope you're all doing well. Hope you're having a great weekend. Today we're going to do the UK stocks I'm buying April 2025 edition. This is the most popular video series that I do on the YouTube channel where I go through all the UK stocks I bought and sold between the 1st of March to the 1st of April. So any moves I made in that time in the UK portfolio will be on this video here today. And I'll do the US one probably on Friday for you guys for all my US stocks. Now, if you're new around here, because we have been getting a lot of new investors at the moment with the stock market going on a bit of a downturn, a few people thinking, is this a good time to buy? So credit to you guys, this is normally a good time to be buying in the stock market. For you guys that are new here, I am a long-term investor. I buy these stocks and I plan to hold them for around about 2 to 5 years, potentially sometimes longer than that, but 5 years is about as far as I could see in the future before things get a little bit blurry. Well, even sometimes 3 or 4 years in the future can sometimes be a bit blurry, but that's what I try aim for. And I try get a 100% return from those stocks when I buy them. So that can be a mixture of just share price returns. Sometimes it can be dividends and a share price return. So we'll see what happens. I'll probably point out to you when I'm talking about the stock what I'm actually planning to get from that one. But apart from that, I hope you enjoyed the video. Like I said, I do it every month, so you can follow along from previous videos how the positions are doing. I can't hide anything because if I've picked a bad stock, it'll be on the previous videos. But yeah, today we'll get stuck onto the UK stocks. Now, if you do ever want to see what I'm buying and selling in real time, the place to be is on the Patreon. On there, I post what I'm buying and selling in real time. As well as that, I give you 2 exclusive videos a week. So for example, I've just done a stock request on Amazon as that stock was the highly requested stock this week from the Patreon members for me to take a look at. And I did a video on it here. And as well as that, there's a Discord with 600 members on to talk about stocks every day, including myself. So if you do want to join, links in the description, £6 a month. Make sure you join through a web browser. Do not do it through your iPhone or the App Store. Otherwise, what happens is Apple will charge you 30% more. So I'm not doing it from my point of view to make more money. I'm doing it from your point of view. It's a lot cheaper if you do it through a web browser and not through the iPhone and the app because of Apple's new fees that they charge. They have to charge 30% higher. So just be aware of that because there's been a lot of people signing up at the moment and I've seen a couple of you get stung by that. And even if you have done it, just go on and cancel and then next month you can save yourself. I think it's an extra £3 a month, which obviously over the course of a year does add up. So you can treat yourself to a Nando's. As well as that, if you do want to start investing, now is a good time and it is the new ISA season. So if you do want to join Trading 212, that's the investing platform that I use. Links in the description and you'll get a free share worth up to £100. Let's start on number one. So number one is Gaming Realm. So overall into this video today, there isn't actually a lot of UK stocks that's going to be on this list. There's actually only 4 UK stocks I bought. And there's actually going to be 4 stocks I sold and I'll reveal them a little bit later on. So not often I get the same amount of sells to the same amount of buys. And I'm not going to lie, I've been a little bit more into the US side at the moment. But there's been a few opportunities in the UK market. And the funny thing with what's going on at the moment is on the UK side of it, while a lot of the US is struggling, the actual UK side of it has actually been doing okay and a lot of them haven't been moving down. Obviously starting with number one, which is Gaming Realms. And if you actually look over this choppy period of time, the stock is actually only down 4%. And when you look at the broader market is definitely down a lot more than 4%. But when you zoom out a little bit, the frustrating thing with Gaming Realms is in the last year, it's actually done pretty much nothing. It's only up 4%. And really since 2021, the stock has been pretty stagnant since that time frame. Now, to be fair, if we do go out a little bit further, you can see here that from about the CV times, the stock did go a bit ballistic and maybe the valuation got a little bit stretched and maybe the valuation has been doing a bit of a catch up to the financials. But now, in my opinion, yeah, the financials have well and truly past the valuation at 12 times earnings, and we'll have a look at them in a second. Now, in case you don't know, what do? They're a developer and licensor, and also they are a big producer of this Slingo brand. So this is a very popular iGaming game that you'll see on the likes of William Hill, Bet365. If you go on their website, you'll be able to play some of their Slingo games that they produce. And they are able to supply these to a lot of their client bases, and you can see some of the clients here. They've got some of the They have got pretty much all the big names as you would expect, like the likes of DraftKings, for example, Ladbrokes. So they have a good client list here. Looking at the latest financials that they actually last week, they actually their full year financial update, and it was absolutely brilliant. Not that you noticed on the stock price, because last week the stock actually went down slightly, but when you look at their latest financial update that they did last week, it was absolutely amazing. Revenue went up 22%, as you can see here. That's a 40% CAGR from 2019 to 2024. EBITDA of 13.1 million, and their US part of their business growing 57%, which is their major growth driver for them. In case you're not aware, iGaming in the US is growing massive. It has only just been allowed in the US and currently in 5 states. And as a lot of states are making these taxes from these iGamings, I think it's going to be allowed in a lot more going forward. And in fact, if you look at the long-term forecast for iGaming growth in the US, you can see here the longer-term outlook, where we have the base case in the light green, would you say, color, and then the bull case in the dark green color, and you can see how much that growth is expected in the next few years in the US iGaming space as it continues to grow. Like I said, the latest financials were amazing. Revenue growth was up 22%. Adjusted EBITDA was up 30%. Profit before tax was up 61% as well. And they also announced so many adverts. Look at this, jeez. They also announced a 6 million buyback of shares. Now, overall, if you look at the revenue growth, absolutely fantastic. Profit growth, absolutely fantastic. And that does mean now the company is around about 10 times forward earnings, which is absolutely crazy for a company that is just coming off 21%, was it, growth, which is fantastic. Now, actually what's interesting is next year there's only just over 10% growth forecast, but if we actually look at their full year accounts that they just reported, they actually did a Q1 trading update. And in the Q1 trading update, they actually said that they have had a fantastic start with their content licensing business growing at 22%. So there's a big disconnect here. Either the guidance is wrong or there's going to be a big slowdown going forward. I would assume it's the guidance is wrong, but we'll see what happens. And as we look at the growth, we can see here the company has had fantastic growth. The revenue has ramped up massively. Look at that profit growth, absolutely amazing. That's what I mean, look at the last 5 years, look at that revenue growth, look at that profit growth, and then we look at the share price. There's just a big disconnect going on here between the share price and the financials. Cracking balance sheet, that's why they're able to do like a 6 million share buyback, because they've got no debt and plenty of cash, and they make 10 million profit every year. That 6 million buyback can obviously go and buy back a good chunk of that market cap, nearly 5% of the company, which is amazing. My only criticism of this company, and I am also going to message the investor relation team, is last week, when it was the full year results, they did a webcast, and I thought the webcast was actually pretty poor. It looked like for how low value the share price is, it looked like the management team didn't want to be there, and it looked like they wasn't really promoting the company that well. They had an hour webcast, and they ended up stopping after like 35 minutes and saying that they were finished. And even me on the webcast, I submitted a question to them asking about going to reporting financials on more of a quarterly basis rather than a semi-yearly basis, what they currently do now, so they can get more updates to the investors and also share more information about the partnerships, because they've been making amazing partnerships with, this year they're going to be expanding into Brazil, and yet they're not really showing it. If we actually go out and zoom out a little bit at the RNSs, there's just a lack of updates from the business. And the fact that I asked them this question and they didn't respond was a little bit disappointing. So I will be following up on that. And that's the only criticism of the business that I do have at the moment. But apart from that, financially crushing it. Great balance sheet, good valuation. Number 2, Card Factory. So same again, for a stock market that's been very choppy at the moment, in fact, it's just crashing. You look at Card Factory, it's actually been holding up in the last month, to be fair. It's only down 2%. Now, I've been a Card Factory shareholder since 2020. During that time frame, I have done a lot of averaging up on my position, because every time I just see this company getting better and better and better, and the share price hasn't really, well, it has sort of reflected it, but in my opinion, it's not reflecting it as much as the financials have improved. It currently trades at 6 times earnings. You are picking up a 7% dividend yield alone on this business. So obviously, 7% a year, the average return on the S&P is 9-10% a year. Not 20% as 30% as some people have got used to in these last couple of years. So alone, just holding this business here, you're going to be locking in that 7% dividend yield, which is obviously, pretty impressive. And then as well as that, I think the share price is undervalued right now. Now, obviously, Card Factory, Most of you guys probably know it because you have got one on the high street somewhere near you, and that is mainly their core business, is that there's the card shops. People don't want to go into the likes of the supermarket and pay £5 a card, or even Moonpig now. Even Moonpig's expensive. You'd rather save money, go to Card Factory, pay a pound for a card. You can even get cards cheaper than that, and you get to save money. Now that's the core business, and they will carry on opening up a couple of stores going forward through the rest of the next couple of years. What is the big part of the company now is the expansion through partnerships. So, for example, they have just become the exclusive card supplier for Aldi, as you can see here. They have opened up their first store in the Middle East through a partnership they do have as well, which you can see here. And also they have made a acquisition to expand into the US through a wholesale of gifts and celebrations as well. There's plenty of other partnerships like the Reject store, for example, but obviously I don't want to take all your time up. So this is probably where the big growth for Card Factory is going forward. And if we look at the update on the 24th of September, this is what spooked the market. So if we do have a quick jump back to Card Factory, you can see here the stock was actually performing quite well, and it actually had this rally up, and then we had this update, and since then the stock has fallen massive. It's down 42% since that update. Now, what happened in that update is basically the market got spooked. They saw this profit before tax number down 43%, and they panicked. They went, whoa, what is this big drop in profit? What is going on? Now, if you actually listen to Card Factory, they told you this was going to happen. And they said that, there's a couple of things. They have to adjust the business a little bit to the big increases of like the living wage, for example. They've ordered a lot of new stock a little bit early on, and by the end of the year, they'll be on for their full year targets. Now, we did also get an update, as you can see here, on the 14th of January. Now, on the 14th of January, they said that, yeah, we told you, we're doing a lot of costs at the second half of the year. By the end of the year, when we get into our peak season, we will hit our full year targets. And even though 5 months on from that time frame, the market got spooked, and since then they've gone, hey, we're still hitting our full year guide. The market still hasn't bought up the Card Factory stock since this dip, which is just absolutely bonkers. And if you look at the recent update, it was a fantastic update. All the numbers you'd like to see, like for like, was up nice. The partnership growth, which we just said is the key driver for them, was up 23%. Great Christmas trading performance as well. And yet the market still isn't reflecting it on the share price. And right now, look at the performance financially from Card Factory. Net profit moving up in the right direction as well. And that's with big increases of the living wage, for example, coming in, the NI issues that are going on at the moment. And that's going to put it down to about a forward P of 5. Now, Card Factory is never going to be a crazy company trading at crazy valuations. But 5 is pretty low, especially for the performance that they have had. And you look at that dividend yield as well. You're getting a nice 7% dividend yield here from this company. Since the new CEO has come in, great performance as well, paying down all of that ugly balance sheet, as you can see here. Now let's sit on a pretty decent balance sheet where they can go make those acquisitions. And if you want a little bit more confidence, what you want to see from insiders is they go buy the shares. And you can see here, insiders have been buying the shares massively. The likes of Darcy Wilson, the CEO, has been buying twice as well during this period, which is a great confidence boost. And I'm a big fan of Card Factory. Number 3, a stock I have not bought for a long time, but I have now. Mobico used to be called National Express. I did buy some shares in this one. So this was a stock I used to own during COVID. The stock did very well for us. We actually came 100% return member. And since then, the gains on this stock have just slowly gone away from the business. And it's actually gone now lower than where it was before the CV situation. Now, I thought I was a bit late to this during this time frame, because since June time, the stock did have a bit of a decent rally out, as you can see here. And I thought, okay, maybe I should have bought, but I missed the boat. The stock has rallied up. Well, since December time, the stock has actually fallen down around about 40%. And financially, they've actually been really improving since this time frame, but yet the stock has gone lower. And I thought, okay, this is time to add into this position. Now, Mobico Group, National Express Group, obviously people just look at them as the coach company in the UK, but they're a lot more than that. So if you look at the business, they do operate in a lot of countries, as you can see here. And that can be like the school bus company in America, the likes of the rail company in Germany, and obviously the coach company that we have in the UK. One thing that is also going on at the moment is they are looking to sell their US school business, and this could potentially be a good cash generator for them where they can pay down some debt on this business, which is probably the only issue really with this company, is that they do have a bit of an ugly balance sheet. Looking at the Q3 update, which was in November time, we are due another one sometime soon, but they say they are on track to deliver their full guidance. Now, this is what has stopped the stock from performing that well in the last few years, in my opinion, is they've not been hitting the guidance. But normally they've told us that around about summertime. The fact that we're on pretty much near where the year end closes and they've still not given us a profit warning, either they're being very sneaky and very shady to their shareholders, or we're about to be in for a time frame where if they hit this full year guidance, the stock actually looks pretty good value, in my opinion. There's never been an issue with the growth of the business. They've always continued to grow. You know, you look at passenger demand, it was up 12% during this period, and it's always been pretty near double-digit growth. The issue that they've always had is they've not been able to, since the CV situation, sort out the profit situation. And with all the cost reductions that they have in place and trying to get the company to in a position where all the inflation issues that have happened in the last few years, is get the profit back to where they used to be. So if we look at what the company historically used to do, they actually used to be a company with very decent profit margins and profit that went up nicely. You know, look at 2015, 82 million profit, 100 million in profit, 114 million in profit, 125, 130, and then just before the COVID situation, we got to 141 million in profit. And then since the COVID situation happened, the revenue has recovered, but they've just not been able to manage the costs, and that's been the big issue. But it's looking like now they are starting to manage the costs slightly, and what we should start to see happen is that profitability start recovering. And if you're doing about even 33 million, 70 million, 86 million, which is still nowhere near where they were before COVID, on a 330 million market cap, that's actually pretty good value. Now, like I said, the debt is probably something that needs to get strengthened out a little bit of the balance sheet, but obviously, hopefully the school bus sale helps pay off some of that debt. And April time last year, there was also some insider buying. But if we do look at Stockopedia, if they are going to hit their full year numbers, you can see here, this is going to put the company around about 6 times earnings. And if they do hit 2025 numbers, obviously the upcoming year, if they hit their numbers, obviously that's going to put it around about 4 times earnings. Now, same again, National Express is never going to be a company trading at crazy valuations, but I would say that it's probably going to be around about 10 times earnings normally, if they can prove they can hit profitability, which obviously is a pretty attractive upside from here. So we'll see if they do hit their full year numbers. And that leads me on to stock number 4, which is Zotefoams. I've covered this quite a lot on the YouTube recently, so I'm going to keep this nice and brief. But yeah, this stock has had a major fall off in especially the last few months, down nearly 53%, pays a nice 3% dividend yield as well. Now, if you do want to see more information on Zotefoams, you can see this video I did 4 days ago, which is around about 17 minutes long, and that'll give you more information on it. If I just quick look at this guy here, what an ugly bugger. If I just scan through quickly though, just to show you some highlights from the video that I did 4 days ago. So they've just closed their full year financials off last year with great growth of 16%, operating profit as well up 20%, as you can see here. The company overall has basically 2 products, the HPP products, the high performance ones, and then the polythene foams as well. This is mostly used in likes of construction, which was a bit flat. The only reason why is because Europe held it back. The rest of the areas grew, but unfortunately Europe is the largest part of their business, so that's what held it back. And this is mostly from footwear. They have a 5-year deal with partnership and a partnership with Nike, and what they do is they supply the foams for their running shoes, and obviously Nike really like them because they've got the exclusive partnership with them. And the plan is that obviously as they go into more of these high performance products with Nike and the partnership gets a little bit tighter, obviously that they should benefit from it. As you look at Nike's recent earnings, even though Nike has had major issues with their company, one of their areas that's actually been performing well is their high performance running shoes. I think that actually grew 10% or something like that, while the rest of the business is showing, and that obviously goes down to Zotefoams. Now, what Zotefoams are going to do is they are going to open up a new factory in the US, which is an area that's been growing very well for them with their more traditional foams, but they're also opening up a new factory in Vietnam to get closer to Nike, because that's where Nike have a lot of their factories, and obviously that should help them with their high performance products with Nike. And hopefully what that will lead them to do is have good long-term growth with a target of 220 million in revenue, and also operating profit expansion from the current 12% up to 18%. So not only just profit growth, but profit expansion because of these higher margin HPP products that they've currently got. Now, obviously, there's a lot of issues at the moment with Vietnam. Looking at the moment, it looks like it is one of the countries that is quite desperate to actually open up the talks and negotiations with Trump. So maybe one of the countries that are more showing that these tariffs might work out compared to someone like the EU, for example, that are currently saying looks like that's going to be a longer match. But I think something like that might be resolved very quickly. And if we look at Zotefoams, 8 times earnings, this company is normally traded a lot higher than this. And when you've got a company, if they do the numbers that Zotefoams are currently expecting, so they've just crossed 148 million in revenue. If they're going to be growing at the levels that they're saying they're going to do, so 7% CAGR in revenue, a 70% CAGR on operating profit, at 8 times earnings, you shouldn't really be getting a company with this sort of growth here. So I think they'll do very well. So I have been buying some Zotefoams. The only thing that I don't like about Zotefoams is that there has been no insider buying. So considering how low the share price is and how optimistic the management team were during the webcast that they did, I thought there'd be some more insider buying, but we'll keep an eye on that one. And that takes me on to the sales. So those were the 4 stocks that I bought. These are going to be the 4 stocks I sold. To be honest with you, most of these stocks were sold just because I needed the money, because I saw better opportunities. I sold them because I saw other opportunities where I thought I can make more money. And I'll show you why. So Supreme was sold for Zotefoams. I covered this on the YouTube channel. Basically, I looked at the risk to reward from Supreme to Zotefoams, and I thought I'm going to make more money from Zotefoams. So I sold my Supreme. And also more regulation coming in through for Supreme and their vaping industry that they're currently in. I did make some good money off Supreme with a 35% share price gain. If you do include dividends as well, that would have pushed me up to around about 42%. And obviously as well, I have been selling shares more regularly before this. So there's been times where I've locked in a 80-90% gain on Supreme as well. So I did sell them shares, completely sold my position in Supreme. Next one is Air Africa. The reason why is just because the stock's gone up so much. It's been on a fantastic rally while so many stocks are not performing well. Air Africa is up 52%. But as we know, it can quite easily go in the wrong direction for Air Africa because of that exposure to a lot of currency risks. And I've been sat on this one for a good while, a good couple of years with the share price not really doing anything. I've got the rewards for buying, and now, I'm going to take some profit off the table and take some of my reward for being patient in this stock, for being a long-term investor. I looked in a 50%, 56% trim on the position, including dividends. That is a 72% gain. And I just took a little bit of a trim on the position. Still hold most of my shares, but just locked in some profit. The next one was Jet2. So I completely sold out my Jet2 position. I sold it for a 50% gain. If you do include dividends, it was probably around about a 55%-ish gain as well on Jet2. Same again, I just thought I'm going to lock this in. There's other opportunities out there that I prefer, like Gaming Realms, Card Factory, JD Sports, even though JD Sports wasn't in this month's edition. Same again, I've made plenty of profit over this one over the years. There's been times where I've locked in a 100% profit because obviously I was buying in the CV situation. The other thing as well, it just came a very small position. So if you do look at the UK portfolio March 2025 update that I did on the Patreon, if you want to see my updates on my portfolio, you can see it on the Patreon. You can see the Jet2 position was just a relatively really small position as well now, because I've not really bought it that much. I've sold some shares and it's just fallen behind the rest of my portfolio. A position of that size, it's just not worth me keeping. I can go use that money into some opportunities right now in the UK markets, because I think there's some big opportunities out there. And the next one was Greggs. Same again, Greggs was the same as Jet2. I bought during the COVID situation. There's been loads of times where I made good money. I think, during this time frame, I sold a good half my position out for 100% return in that time frame. And even though the stock has, it's probably slumped quite a bit. And you know what? I actually wouldn't mind to be a buyer at these sort of levels. I'm not going to buy it though, just because I think There's other stocks I'd prefer, you know, like the likes of Card Factory, Gaming Realms, JD Sports at the moment. I think they're better opportunities than Greg's right now, even though I wouldn't mind Greg's at these levels. I don't want to have a million retail stocks in this situation. So even though I like it, and I'd probably actually rather be a buyer than a seller, I just had to look at it and think, you know what, if you look at the position size in here, it's just not worth me keeping it in the portfolio anymore. So I thought, you know what, let's cash that position out, and with the money that we have there, put it into some other opportunities out there. It's not worth me doing the upkeep, doing the research. You know, what I have to do for that position is the same that I have to do the research on like the JD position. It's just not worth it. So take the profit. We've made some good money, you know, 30% profit. If you include the dividends, we're up to a nearly 50% profit on this one. Obviously, as well, there's been other times we've made other trims on it for even bigger profit. Time to walk away. And you know what? If Greg's does go absolutely ridiculous to, like, I don't know, let's say it drops another 20-30% from here, you know what? I might be tempted to buy. But I just think even though I think Greg is actually, I'd rate it a buy rather than sell right now. I just think like the likes of JD Sports are probably a little bit more interesting at the moment, but we'll keep an eye on it. But yeah, I just had to make sure I don't want to be a giant ETF portfolio. I want to consolidate into the best opportunities. And even though I like Greg's, it's probably not the best. So in my opinion, anyway. So yeah, hope you enjoyed the video, guys. Hit the like button, and yeah, hopefully I don't get this video up to you too late on the Sunday night. We'll see what happens. Thanks for watching if you made it all the way to the end, and see you in a bit.